Hello everyone, my name is Vikas Shukla, and in today's video I'm going to talk about a strategy which is specific to NIO, but it applies to other shares as well. NIO, because this is the stock I am talking about, I have been talking about over the recent week, and it's because it's easy to understand with an example, with one stock in mind. Otherwise, if you are a newcomer to the field of options trading, that things get complicated to understand. So let's start with this example of NIO stock. What we want basically is, at this today, as of today, the NIO price is at $13.50 about. Don't quote me for this, and it does not matter, the prices can keep changing, but let's say it's today's price is 13.50, and we want to acquire this stock at a lower price at $12, but we missed the train. But there is an opportunity with this thought that we know about this stock, and we know that 13.5 is a little higher than I want to pay. I'm okay with $12 price. I would have liked to acquire it. So for this we use a strategy called NIO put sell strategy, and I won't go into the definition of put sell strategy. They could get difficult to understand, but it gets very easy to understand with this example. So what do? I set my, this is, I call a strike price. I'm saying that this is the price at which I would have liked to acquire it. And then there's another variable that's called strike date, and that date is either weekly or monthly. So let's talk about the weekly. Today is August 4th, and the next weekly date, strike date, is going to be the Friday or August 7th. This is too close, so I will leave that August 7th, and then I will go into this August 14th strike date, which is the next Friday. Now what I do is, and then there is this third term here, I call that premium. So this premium, let's say it's, and this also keeps changing. So what I do is I sell a put. What does that mean? Selling the put means that I want to acquire this $12 NIO stock on August 14, and there is a premium of 50 cents, which means if on August 14th there are two things can happen. Either the stock will go below 12 or it will stay above 12. Let's say it stays above 12. We wanted to acquire the share, but the share stayed above 12. In that case, you don't get the share. You don't buy the share. You are not forced to buy the share. But what we do get is that 50 cents premium, if that price is 50 cents, and I will show you what the exact price is right away in the current market or a previous close price. So I'm trying to buy at 12, but because the strike price was not met, I still get 15 cents. Now when I do this thing, my $12 is blocked, which means that if I, one option is for 100 share, so $1,200 will be blocked in my account, and at the end of this share, August 14, I will be making $50. And if you take into the percentage, it will be about 4% if it's 50 cents. So in 2 weeks, I make 4% of profit, and I don't get the share. But let's say the share goes down below 12, and it keeps going down. At it on August 14, it's at $11. What do? I get the share at $12, and I also get the premium, so my effective price is $11.50. So if I got to buy the share, I got to buy at, instead of $13.5, I waited a week and a half, and I got it at a $2 lower price. Now because the share is further down than 11.5, you can say that I would currently be making a loss of 50 cents, but that's okay. I made a little bit of loss. If it would have been much worse if I would have bought it right at $13.5, in which case my losses would have been 13.5 minus 11, or $2.50, a big loss. So this is the strategy that I have been using, and my strategy is more about collecting the premium for most of the stock, and then I do not intend to actually buy it. I only intend to collect the premium. I don't want to own the stock, and primarily because the stock market is already high. It's not a right now. The things could change. I mean, at some point of time, I would like to have the stock or buy the stock, and that brings me to the next question: how do you select the strike price? You could select the strike price very close to current price. Where, for example, I could also select the strike price as $13, maybe $12.5, or $12 is close but not very close. But I could also choose my strike price very far from $13.5, could be $11 or $10. So what is the effect of choosing? How do you choose the strike price? Should you use very close or should you use very far away? And that depends upon what you are trying to do. If you desperately want to own this stock, which is $13.5, but you want to pay a little less than that, and you don't want to miss the train has started running out, and you just want to somehow grab that, then maybe you want to keep your strike price at $13. And in that case, your premium, you also get a little higher premium, which means that if you are not able to grab this moving train, you get a higher premium. And if you are able to get that, because of that premium, your price, that will be a little lower than 13, which means that you may be getting 80 cents for a $13 strike price. So that's how you choose the strike price. But if you if you see that $13 is still very high, you set your strike price lower. For what I typically do is, my intention is to collect the premium, I keep a little far so that I don't get that share. I only get the premium. So that is how you strategize it. Once in a while, I even setting lower, the share gets allocated because of some wrong news or something. I do get that share stock, which is fine. I get it at much lower than the current price, and what I do is I use another strategy at that point. I call it call sell strategy, that I think I covered it into another video. The second variable is the strike date, and that also you need to choose very carefully, and you will know it once you start executing or working on these variables, and you need to experiment it. What is the best strike date? You could start with August 7, you could start at August 14, August 21, and so on and so forth. There are few things to keep into mind. If you choose August 7th, then your premium is smaller. If you just use August 14, your premium is higher. So by keep varying this date, you need to choose the date which will get you highest premium per week. So remember, it's about the rate of the premium per week. Maybe August 7 is too low, the premium is too low, and it may not get that low, or so you need to keep moving on this day. So I usually do not go much farther than like 3 to 4 weeks. I typically see that between 2 to 3 weeks is the sweet spot where I get the highest potential return. You need to keep in mind that the weekly premiums are available only for the next 2 months or so only, and thereafter it shifts to the monthly premium. So I will have another video about this thing. So put sell strategy is used to potentially acquire a share at a potentially, because you may or may not get it, potentially acquire a stock at a lower price, and if you do not get to allocate the share, you at least get the premium. And you do it for a stock that you actually would not mind if that stock is allocated to you. You usually use this strategy if your intention is for a premium. You usually choose a stock which is moderately volatile. If a stock is very settled down stock, the premium will not vary much. For example, Intel stock, unless it's a very bad news surrounding about it. Another similar very solid stock, maybe Walmart and things like that. They are very, the percentage weekly premium will be very less. So I do not, for the premium purpose, I do a little bit of volatile stock. But when you do volatile stock, there is a chance that the share can go down dramatically by the time it hits the strike date, and then you could be feeling like losing a lot. So to 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 overcome this the drawback, what you do is you diversify. You don't put all your money input sell for all shares. So let's say I usually do it on three different stocks. So you do a put sell on three different stocks. So if one of them has a very bad news, and because of that the stock goes down, for example, this one is 13.50, I have a strike price of 12, I am gaining like potentially 50 cents of premium, and this stock price suddenly goes down to $6. It can happen, it does happen. I mean, the stocks move more has more movement or more swing than you potentially think. So I lose quite a bit of money here, almost 50%. I lost almost 50%. It's $12, and then it went down to $6. So but by diversifying, and the chances are very less that it will happen on all three stocks, so you will still be preserving and hopefully make up the money from the other two stocks. So I hope this covered something. Or well, last thing I wanted to show you is in my this tablet. I just wanted to show you. So I actually should have done it using a screenshot, but I'm not able to. So this is the stock for the NIO. I hope you can see this NIO stock right here. Let me zoom it, and then you go to the options tab, and then you scroll down, and then you scroll down. The top one is for the call, and the lower one is for the put sell that you can see here. You can select the strike date, which in my case is August 14, that you can see right here. This is the August 14 strike date. Now I scroll it down to select my strike price that I talked about. It's $12. So you can see this $12 right here. And then if you can see the price that closed for this $12, this guy here is it's 63 cents that I showed in this one. So just to show you again, this 63 cents, which means that it's even better in terms of premium. It's even better than the 50 cents that I took as an example. So I hope this helped you. Just I wanted to show you once more. The strike price $12. Anyway, I will leave it here. I hope you got the feeling of it. You need to go down to finance.yahoo.com or your brokerage account, look for the options tab, and not all brokerage accounts are approve the options trading, and you will have to get an approval before you can start the options trading. But it's a good strategy. Thanks for taking a look.